Company ownership and control is a fundamental concept in corporate governance that explains the relationship between those who own an organization and those who manage its operations. In modern corporations, shareholders provide financial capital and hold ownership rights, while directors and executive managers exercise decision-making authority over the organization's resources and strategic direction. This separation of ownership and management creates both economic efficiencies and governance challenges, making effective governance systems essential for protecting shareholder interests and ensuring managerial accountability. Within the program, the distinction between ownership and control provides the conceptual foundation for agency theory, board accountability, performance monitoring, and stakeholder governance. Corporate governance therefore exists largely to regulate this relationship and minimize conflicts between owners and managers. In publicly listed companies, ownership is typically dispersed among thousands of shareholders who individually possess limited influence over day-to-day management decisions. Shareholders exercise ownership through voting rights, appointment of directors, approval of major corporate actions, and the receipt of dividends and capital appreciation. However, because ownership is widely distributed, individual investors rarely participate directly in strategic management. Instead, they delegate authority to the board of directors, expecting professional managers to maximize organizational performance while safeguarding invested capital. This delegation creates an agency relationship in which directors and executives act as agents responsible for managing resources on behalf of shareholder principals. The separation of ownership and control gives rise to the agency problem, which occurs when managers pursue objectives that differ from those of shareholders. Executives may prioritize personal remuneration, job security, prestige, empire building, or short-term performance targets rather than long-term shareholder value maximization. Such conflicts create agency costs, including monitoring expenses, incentive payments, governance mechanisms, and potential losses arising from managerial decisions that fail to maximize shareholder wealth. The governance framework identifies this separation between shareholder ownership and director control as the principal reason corporate governance systems are required to ensure accountability and align managerial behavior with organizational objectives. Corporate governance mechanisms seek to reduce agency costs by establishing effective systems of oversight, transparency, and accountability. The board of directors represents shareholders by monitoring executive performance, approving strategic decisions, supervising risk management, and ensuring that management acts in the best interests of the company. Independent non-executive directors, audit committees, remuneration committees, and nomination committees provide additional oversight by challenging executive decisions and promoting objective governance practices. Performance-based remuneration systems further align management incentives with shareholder interests by linking executive compensation to long-term organizational performance rather than short-term accounting outcomes. Ownership structures significantly influence governance effectiveness and strategic decision-making. In companies with dispersed ownership, management often possesses considerable operational autonomy because no single shareholder exercises dominant control. While this facilitates professional management and broad capital access, it may increase agency problems because monitoring by individual investors is relatively weak. Conversely, concentrated ownership, where institutional investors, governments, founding families, or major shareholders hold substantial equity stakes, strengthens monitoring and reduces managerial discretion. Large shareholders often possess sufficient influence to challenge management decisions and demand stronger governance standards, although concentrated ownership may also create conflicts with minority shareholders if controlling investors pursue private benefits at the expense of wider stakeholder interests. From a strategic management perspective, effective ownership and control arrangements contribute to sustainable organizational performance by promoting responsible leadership, prudent risk management, and evidence-based decision-making. Boards must balance the interests of shareholders seeking financial returns with those of employees, customers, suppliers, regulators, and society, recognizing that long-term value creation increasingly depends upon responsible stakeholder engagement rather than short-term profit maximization. Consequently, modern governance frameworks adopt a broader stakeholder orientation while preserving accountability to shareholders as providers of risk capital. The evolution of institutional investment has further transformed ownership and control relationships within modern corporations. Pension funds, insurance companies, sovereign wealth funds, and investment managers increasingly exercise active ownership through engagement with boards, voting on governance matters, and influencing corporate strategy. This phenomenon has strengthened shareholder activism and encouraged greater board accountability, transparency, and environmental, social, and governance (ESG) reporting. Institutional investors now expect boards to demonstrate effective oversight of sustainability risks, digital transformation, ethical conduct, and long-term strategic resilience alongside financial performance.